For your money this noon, it's been reported over the last few weeks that the Fed is planning to increase their rates 2 or 3 times in 2017. The impact for you might not necessarily be bad. Andy Manningly from Forum Credit Union is here to talk about it. Okay, so what's the most immediate impact if the rates do go up?
Well, if the Fed raises their rates, the first thing that goes up is prime rate. That's the rates that financial institutions charge their most favored customers or the best credit customers. So that means rates will go up a little bit, but it's not catastrophic if the Fed raises the
Okay,
rates.
so what type of debt does that affect?
Well, that's going to usually be any new debt, so fixed or variable new debt, but primarily if you have debt, then you only have to worry about your variable rate loans, so credit cards, signature loans, home equity loans, and if you have an ARM for your home loan.
And if they increase this, is it something that the next day it takes place, or is it phased in?
No, it's going to be phased in. You know, with the Fed's change in December, most people probably haven't seen an increase until, the middle of this month or the 1st of February. So it can take 30 to 60 days. If it's a adjustable rate mortgage, you might go a whole year or 6 years, depending upon how long until the rate changes can happen.
Okay, should you avoid adjustable or variable rates then?
Not necessarily, because it could still be good for your situation. For example, say you're buying a new home and you know you're going to move in 7 years. If you get a 7-year ARM or a 10-year ARM, it's not going to adjust, and those rates are usually lower than a fixed rate. So you have to really look at your situation. Not all variable rates are bad, even in a rising environment.
Okay, so let's look more at mortgages. I think when somebody hears rates, they immediately think mortgage rates. Are they affected then?
Well, usually mortgage
directly
rates...
affected?
Usually mortgage rates aren't directly affected by the Fed raising the rate. It's more what happens in the economy and what happens to long-term and short-term Treasury rates. So if those go up or down, then mortgage rates will go up. In the past, it's probably 50-50. The Fed could raise the rates and mortgage rates could actually go down.
And you just touched on this a little bit. If somebody does have an adjustable rate, which were in the news so much years ago, should they be concerned?
Well, only concerned if you know the rate's going to change soon, but most of those rates, you can only go up so much every year, so then you're able to look and see if that's really going to be a problem or if you just need to stay in it.
Okay, so what do you do if you are concerned about that?
Then refinance to a fixed rate mortgage, or if you have a credit card that's a variable rate, then look for a fixed rate credit card, things like that.
Should we talk about this as much as we do when the Fed is going to increase rates? Because it kind of affects...
Yeah, I think we just have to make sure that you just need to look at your situation and make sure you don't get scared by it. It doesn't have to be a bad thing. And we are also at historically low rates. Yeah. So even if rates go up a little bit, I think, it's still a good sign that the economy can still go and we can still borrow and not pay too much for that money.
All right, Andy, where can people find you?
At forumcu.com.
And you need to listen to this because we got a consumer alert.